Hey everyone, welcome back to Corporate Decoder, the place where let's just say we're about to decode a company that is trying to rev up its engines in the auto and insurance world, and just maybe, it is sputtering a little more than we'd like. Today we're diving deep into the latest report from SunCar Technology Group Incorporated. Think of it as peek under the hood of their finances, and trust me, some of the results are going to make you raise an eyebrow. If you are new here and appreciate getting straight insights from financial documents, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these reports even further. Alright, so what is SunCar Technology Group Incorporated? They're operating in China, focusing on auto insurance services, technology services, and auto services. They're trying to be a one-stop shop for car owners and businesses in the automotive and insurance space. Let's jump right into the numbers. We're looking at their balance sheets as of the 31st of December 2024, and then a more recent snapshot as of the 30th of September 2025. Total assets have grown from about $246 million to over $273 million. That sounds good, right? More assets usually means a bigger, more established company, but here is where it gets interesting. While their assets are up, so are their liabilities. Total liabilities went from about $180 million to over $185 million. So they're growing, but they're also taking on more debt. Their short-term loans alone jumped from $83 million to almost $88 million. Now, let's talk about shareholders' equity. This is essentially what is left for the owners after all the bills are paid. This section has seen a big jump from about $11.8 million for the company's shareholders in 2024 to over $29 million by September 2025. That is a significant improvement, suggesting they've managed to increase the owner's stake in the company, likely through issuing more shares. However, a huge chunk of their total equity, over $54 million, is attributed to non-controlling interests. This means a significant portion of the company's profitability, or losses and assets and liabilities, don't actually belong to the main shareholders. This is common in businesses with subsidiaries, but it does dilute the direct ownership benefit. Now, let's look at how they performed financially. We're examining their operations for the 9 months ending the 30th of September, comparing 2024 to 2025. Their total revenues have increased from about $312 million to $338 million. That is an 8% rise, mostly driven by their auto insurance services, which saw a 25% increase. They specifically highlight that revenue from electric vehicle insurance services is booming, growing by over 72%. This is a positive sign that they're capitalizing on a very strong growth trend in the EV market. However, their auto services revenue actually dropped by 5% from $159 million to $152 million. They say this is a deliberate decision to stop doing business with low-margin clients. While cutting out unprofitable activities can be smart, a 5% drop in such a core segment is still worth noting. The real story here, though, is on the expenses side. Total operating costs and expenses decreased by 9%. From $371 million to $336 million, this looks like a huge win, right? But the report says the main reason for this big drop is a reduction in share-based compensation. In 2024, this sounds like they had a massive stock-based expense in 2024 that significantly inflated their costs that year, and by comparison, 2025 looks much better. Their general and administrative expenses dropped by a massive 60%, and research and development expenses fell by a staggering 90%. This is largely due to that specific 2024 equity incentive plan expense, which, when removed, makes the 2025 numbers look incredibly efficient. Because of these changes, their net loss has shrunk dramatically. From a loss of over $61 million in the 9 months of 2024, they are down to a loss of just over $4 million for the same period in 2025. That is a nearly 93% improvement in their net loss, which is a huge turnaround. The company is trying to look leaner and more efficient by cutting down on these specific 2024 costs. Looking at the changes in shareholders' equity gives a bit more context. We see a significant increase in additional paid-in capital from $208 million to $233 million. This is likely from issuing new shares. In fact, they mentioned issuing over 7 million Class A ordinary shares in February 2025, which brought in about $41.6 million. This influx of cash boosted their equity. Interestingly, they also started a share repurchase program, buying back over 3.4 million shares in early 2025 for about $15.8 million. This is a strategy often used by companies to return value to shareholders or to signal confidence in their own stock. They also mentioned a concerning event where they acquired a non-controlling interest, which resulted in a loss on their equity. When we look at cash flows, things get a bit more complex. For the 9 months ended the 30th of September 2025, they actually used more cash in operations, a net outflow of nearly $11.1 million compared to the previous year's inflow of about $1.2 million. This is a bit concerning despite the improved net loss. They attribute this to an increase in prepaid expenses and other current assets, mainly due to more advances to suppliers, which suggest they're stocking up or paying ahead for future operations. Their investing activities also show a consistent outflow of cash around $9 million for both periods, primarily for developing their cloud infrastructure. Financing activities, however, show a swing from a cash outflow of $2.3 million in 2024 to a cash inflow of over $16 million in 2025. This reflects the share issuance we mentioned earlier, combined with new borrowings, which helped offset their share repurchases and loan repayments. Let's delve into some of the important details in the notes. The company's structure and history are pretty typical for companies going public through mergers, but the key is they operate mainly in China. Their revenue recognition policies tell us they earn commissions from insurance companies when a policy is effective and premiums are collected. For technology services, they earn recurring fees, and for auto services, they recognize revenue when a service is performed or when a coupon expires. This generally sounds standard. This section is a bit dense, but it talks about warrants. Warrants are essentially options to buy shares at a certain price. SunCar has issued quite a few warrants, both to investors like GEM and for their own offerings, including placement agent warrants. These can be complex financial instruments. The report details how they account for these, and some are treated as liabilities, meaning their fair value changes can impact the income statement, which can create volatility. Here we see concrete actions. The issuance of over 7 million shares in February 2025 was a significant capital raise. The share repurchase program starting in February 2025 shows they are actively managing their share count. The acquisition of non-controlling interests is also detailed here, showing they bought out a small piece of a subsidiary for $2.2 million. SunCar operates in various jurisdictions, including the Cayman Islands, Hong Kong, and mainland China. Their Chinese subsidiaries are subject to a 25% enterprise income tax, but some qualify for a reduced 15% rate as high and new technology enterprises. They also highlight tax preferences for small-scale, low profit enterprises. The company has significant net operating loss carryforwards, meaning they have past losses that can offset future taxable income, and they've recorded valuation allowances for these, indicating uncertainty about future profitability in some areas. This is a critical area for any business. SunCar has significant dealings with Shengda Group, an entity controlled by their CEO, Mr. Yi Zaicheng. They owe Shengda Group a substantial amount, over $11.8 million as of September 2025, related to the transfer of a subsidiary. They've been negotiating payment extensions and interest rates. They also owe a smaller amount to Mr. Lei Junfu, their Chief Technology Officer and Chief Operating Officer. While related party transactions are common, the scale of these obligations and the fact that they're with entities linked to key management warrant careful attention. The fact that some of this debt was settled by transferring shares of a subsidiary is also noteworthy. It is a form of non-cash transaction that can be complex to evaluate. This section highlights future obligations. They have lease commitments for offices and a substantial capital commitment of over $35 million for cloud infrastructure and AI platforms. This indicates significant planned investment in their technology. They also mention a legal dispute with GEM, where an arbitration tribunal awarded GEM $2.8 million plus interest. GEM has filed to convert this into a money judgment, and a winding up petition was filed by GEM against SunCar, though this was adjourned based on a payment arrangement. This legal battle is a significant risk. After the 30th of September 2025, there was a court ruling that could reduce Shanghai Feiyu's equity in SunCar Online. While SunCar believes they will still control the subsidiary, this could have implications. Also, the GEM winding up petition was adjourned following an agreement for SunCar to pay GEM over $3 million in installments. These events occurring after the reporting period carry ongoing risks. Let's zoom out and look at the bigger picture. SunCar's strategy seems to be focusing on growth in auto insurance, especially EVs, leveraging their technology platform and trying to streamline their auto services. The synergy between their insurance and auto service businesses is a key part of their narrative, with service providers becoming sales partners and vice versa. They point out that maintaining good relationships with enterprise customers and end consumers is crucial. Cooperation with service providers is also vital for the quality of their auto services. Operating efficiency is a goal, and they believe their cloud platform and AI initiatives are key to achieving that. Interestingly, they downplay the impact of inflation, citing China's stable inflation rates. They also believe EV insurance will offset any negative impact from fuel prices. This shows a targeted strategy to lean into the EV market. Now, for my take on SunCar Technology Group Incorporated, on the bright side, SunCar is showing significant revenue growth, particularly in auto insurance driven by the booming EV market. Their dramatic reduction in net loss from 2024 to 2025, largely due to shedding specific large expenses from the prior year, makes them look much more profitable on paper. The significant increase in shareholder equity due to equity issuance like the 7.1 million shares in February 2025 injected much needed capital. However, there are clear areas of concern. The company's net cash used in operating activities increased in 2025, meaning they are burning more cash to run the business day, today despite the improved net loss. This is partly due to increased advances to suppliers, which could be a sign of either expansion or potential cash flow management issues. The substantial related party transactions, especially the debt owed to entities controlled by the CEO, raise questions about governance and potential conflicts of interest. The ongoing legal disputes, particularly the GEM situation with a winding up petition and a large debt obligation, represent a significant immediate risk. The company's strategy to lean heavily on EV insurance is smart in the current market, but the drop in auto services revenue, even if deliberate, needs to be closely monitored. Overall, SunCar appears to be in a transitional phase, trying to grow rapidly in a key market, while managing significant financial and legal challenges. The improvements in their financial statements look partly driven by cost reductions on specific items rather than uniformly strong operational performance across all segments. Investors should watch closely how they manage their cash flow and navigate the legal and related party obligations. Alright, that is our breakdown of SunCar Technology Group Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.